Jonathan Schein, and this is the IREI View from the Top video series. And today we are interviewing Steve Furnary, CEO of Clarion Partners. Welcome, Steve.
Thank you, Jonathan.
You know, one of the first things that came to mind when talking with you is when you're discussing an investment strategy with your team, what is the number one consideration you want everyone to stay focused on?
Well, I think it's a management of the intersection between risk and growth.
Okay.
And of course, we're in a part of the cycle now where I think the accent can be on growth. A lot of people concerned about risk, a lot of people talking about risk, but frankly, with the markets all converging together at these low cap rates, I think the number one consideration is to choose the markets and the property types within those markets where there's actually growth that will take place beyond really what the appraisal market and the seller has put together as a sales package.
Well, when you're discussing this with your team, they come back to you and say it's really getting harder and harder to find the proper deals, you know, with yields compressing. How do you manage that through your strategies?
Well, I would say just work harder. It's a big country. There's a lot of real estate, and you might have to cull through more investments to actually find investments that meet all of the criteria that we're looking at. But in terms of how we actually go execute on that, we in our firm we're very fortunate. We're large. We have 1,100 properties across the country. There's a lot of research that permeates up from that, and we have a research group that does a lot of top-down work in terms of choosing markets that have high and high income population growth, high income growth, and high population growth, and which allows us to target the particular submarkets that we want to focus on for each property type. So when we rub together the research that permeates up from our portfolio and what we actually bring together top down, I think we are in a very favorable position to actually target assets that make sense for us.
So, what do you see as, you spoke about a few of these factors, what do you see as the most important drivers affecting U.S. real estate today?
Well, I do think it, I think it gets back to growth, okay, and that's population growth, income growth, and it's in effect, when you start applying that to the real estate, it's the investments that will generate a growth in income. You can look at a lot of, let's assume the whole market is capped today at a 5% cap rate, and frankly, it's not that far from the truth. So the key is to choose the assets where you actually get an uplift, and that you can look through every property type to do that, and to see where you believe you can achieve that. I think we do a pretty good job of that. I can tell you very often we're looking at a projection and it's pretty flat for a long period of time, right? So those are investments that are easy to sort of stay away from and to focus our activity on those investments where we actually see the uptick.
So you're looking at altering some of your strategy, I imagine, and I was wondering if you could give us an example of where you've done that.
Well, the strategy is different for each client portfolio and each client. So we invest up and down the risk spectrum. We invest in core, value add, and opportunistic investments. Very often we're doing development. I would say the biggest change in the strategy across the entire portfolio today is that we're doing a lot of value add / development to core. And that means we create the value over the first 3 or 4 years, and then we, unlike in the past, we very often hold the asset for a longer term hold. We have clients that want to do that. I think the market is actually, a lot of our clients rather have actually figured out that there's a lot of lost return in waiting to get invested and waiting to get reinvested after you sell an asset, and therefore they're very much focused on getting the alpha that you can get by creating the value and then holding the asset for a longer period of time, and eliminating some of that lost return that takes place when you are getting your capital back and looking to reinvest it.
Okay, and so, there's a lot of foreign capital in the market right now. How is this affecting and impacting your business today?
Well, it's just made the market more competitive. So I can tell you there's very often there's a good side of something and a bad side of something. So the bad side of it is it's simply more competitive to buy. In many cases, the offshore capital is motivated a little differently, and and just by the very volume of that offshore capital, the cap rates are falling and the prices are going up. So that's the negative side. The positive side for Clarion Partners is that we are continuously adding more offshore capital to our stable of investors. And if that cost of capital is less costly, that allows us to be competitive for that capital in the broader real estate market. So, this isn't new. This is just not new. There's been lots of times in the market where foreign capital has been the predominant source of capital. It was generally from different parts of the world. We now have sovereign wealth funds, and they're frankly from many parts of the world, which are pretty aggressive. They need to be because they need to get their capital out. There's a lot of flight capital, but flight capital is not a new term. That's been around forever. So I don't think sort of being worried about one source of capital is any different than being worried about whatever part of the world there's less costly capital coming in and maybe having a negative impact on the market for your less low cost of capital.
Understood. So you built your business to last, and you've certainly been through several downturns. Especially the last one has probably been the most painful for anybody. You're in your fourth, and this one, the GFC, was probably the most painful. What kind of strategies do you implement to keep the business going? I mean, what has it taken to keep a business that lasts?
Well, I'd like to tell you that we knew the global financial crisis was going to happen, and we modified our behavior because of that. Okay, that isn't true.
It's not true.
That is not true. However, more broadly, our firm is now 33 years old.
Okay, so you have been.
And one of the things that we have worked very hard to do is to diversify the firm itself, so that even in the bad times, and again, we've had 4 of those parts of the cycle. It seems to be sort of every 10 years that this takes place. And when you go through the bad times, that you have some sectors of your business where the tide is coming in.
Okay.
So how have we done that? We've diversified by property type. I've already mentioned we've diversified by risk, the application of risk in the portfolios. We've diversified by capital. We have offshore capital and onshore capital, and within that, the confines of that, we have capital from lots of different types of groups. So whether it's pension funds or endowments, foundations, sovereign wealth, it's a relatively diversified capital base. And we've been very fortunate that as we've gone into these downturns, we've been able to slow down the business. We've been able to, in certain cases, we've only done that once now in the 33 years, where we actually had to shrink the firm to get through that, and I think most people actually went through that. In the normal cycle, it's simply sort of redeploying people. It's redeploying people from new investment activity, because that usually goes away for a while, and having them focus on, let's call it dealing with or working out the existing portfolio, managing the existing portfolio. So Clarion is large enough, given the size of the portfolio and the fact we operate out of 8 offices, and some of those markets are good when other markets are bad, and we're highly diversified way beyond the 8 offices in terms of where we invest. So if I was to boil this down to one word, it's diversification. We have a highly diversified business. Right now, we're investing a lot more in mezz debt. We just started a mezz debt business, and we've had them in the past. We have them now. Why? We have some clients who are looking to have a higher current return, and we think we're getting the same return as the equity return. You don't have an inflation hedge in that, but for investors that are worried about where we are in the cycle to get a higher current return, it's equivalent to the equity return, and to have a cushion so that when you get to the downturn, it's someone else's problem, is an intelligent way to invest. So for Clarion, it's just being really diverse.
Well, that's quite interesting because there are a lot more debt products coming on the market right now. So, in closing, if you had to do one thing differently, what might it have been?
If I had to do one thing differently, I have to tell you, that's a tough question for me, because I've actually been unbelievably blessed to have joined a group of folks, a group of partners to create a business and to expand it over, a 33-year time frame. We have great clients, and in terms of my professional life, I would say there's really not a lot of things I would do differently. I would have my radar up earlier for risk management. I think we're all getting better at that. I can tell you we are much more attuned to that, and we will change our behavior when we're getting closer to where we believe that's a risk. So if I had to do one thing differently, I was sort of thinking out loud here while I was speaking, I would say it's to have the radar up better for the downturn, and to modify our investment behavior, to deleverage. There are a lot of people that say, okay, you're coming into a bad time, why not just sell everything? Well, that's completely ridiculous. Our clients don't want us, first of all, to give them their money back at exactly that time. They probably have their money in lots of other places where it's more exposed. But you can do things. You can lengthen leases, and you can beforehand, and you can delever yourself, when you feel like you're coming into that. So I'm hopeful as we look forward that our radar will be better on that, and our research, which is something that we spend a lot of time and money on, will allow us to effect changes earlier and protect capital on the downside.
Well, thank you very much. Steve Furnary, CEO, Clarion Partners, IREI's View from the Top.
Thank you, Jonathan.
Thank you.